90% of my liquid net worth is basically allocated right now to Solana. I moved some from ETH. I don't have much Bitcoin right now. Doesn't mean I don't like Bitcoin. I just think the others go up more. Simple as that. I own a bunch of high-end NFTs that I think I have another thesis about. And then beyond that, I do a bit of speculation and other stuff for the fun of it. But the time horizon thing is, I can see it freaks everybody out. And I've stepped back, and it was only in the last 2 weeks I've realized the risk, the real thing that's going on crypto Twitter, and why the banana zone resonates and why you get this backlash is this is everybody's hopes and dreams. It's everybody. It's yours, it's mine, it's everybody's. Right, so they're so scared of it going wrong, yet they're so greedy to get it right. This is the struggle that everybody's having. Mm-hmm. And people have PTSD from the last cycle, as the people did from the previous cycle. Right, the previous cycle was the blow off top and then the collapse. This one was the stunted top and then the collapse. And so now people, they worry about the cycle. Mm-hmm. I don't remember Jeff Bezos caring about the business cycle. He just owned his stock.
In his recent interview, Raoul Pal, CEO of Real Vision, explains why we should stop worrying about the current cycle and focus on owning important cryptocurrencies. Pal states that 90% of his liquid net worth is allocated to Solana. He has moved some of his investments from Ethereum and holds very little Bitcoin. This doesn't mean he dislikes Bitcoin. He believes other assets, like Solana, have greater potential for appreciation during this time. He also observes that the cryptocurrency community is deeply emotionally invested. People are driven by fear and greed. They are afraid of things going wrong, but also very eager to get things right. However, Pal suggests taking a long-term perspective, similar to how Jeff Bezos focuses on owning his stock, regardless of business cycles. The implication is that instead of getting caught up in market cycles, investors should focus on the long-term potential of their investments. In other news, CoinDesk published an article about investors buying the dip on Friday. After the July 4th break, US traders returned to find that the price of Bitcoin had plunged by more than 10%, dropping from nearly $61,000 on Wednesday to under $54,000 early Friday. In response to this decline, investors bought into Bitcoin exchange-traded funds, leading to substantial inflows of $143.1 million on Friday. This was the highest level of inflows in at least 2 weeks. Notably, Fidelity's Wise Origin Bitcoin Fund attracted $117.4 million of the net new money. Other ETFs that saw net inflows included the Bitwise Bitcoin ETF, the ARK 21 Shares Bitcoin ETF, and the VanEck Bitcoin Trust. With that being said, let's take a look at some clips from Raoul Pal's interview. Please take a moment to show your support by liking the video and subscribing to the channel. Thanks, and enjoy the video.
I don't trade anything in macro really anymore. My personal portfolio is pretty much, well, it's 100% crypto. Within Global Macro Investor and Real Vision Pro Macro, there are some technology bets and other bits and pieces around that because it's all part of the same trade. What I found over this process was that everybody in macro had been struggling for about 10 years. The odd trade came along, like the buy bonds where diamonds trade. You can make a ton of money on it. But people were struggling because we didn't understand the world. Equities just kept going up and we just couldn't get our teeth into anything because we weren't looking at the right thing. There was a mega trend going on, which was this liquidity cycle. And once you saw it, you realized that everything was correlated to it. So if everything is correlated to it, then it becomes interesting to say, okay, well then, if it's all the same trade, what's the best performing asset? Now, the other really important thing, what I think has happened, and it took me too long to realize this, I'm annoyed at myself, is that the Federal Reserve and all the central banks took away left tail risk. Left tail risk in a global macro view really is a debt deflation, which is when the value of your collateral falls too much that you can't pay for the debts and it gets called upon. And people sell the collateral and you get into this cycle. We had that in 2008. What did they do? Debase the currency. What did it do? Optically make asset prices rise, so the collateral went up. The Europeans did it even harder in 2012. So what they've said, and then we did it again in COVID. So what they've said is, you cannot have a debt deflation. We will not allow it. And we will debase the currency by 8% a year to pay for it. Think of that as a put option that you're paying. on the system not blowing up, which is a very different way of looking at it, as opposed to, I can't believe they're robbing me of 8%. If you say, hey, listen, it's a mutualized cost of a put option, and we all pay 8% so the whole system doesn't blow up. Okay. So if we've taken away the left tail and everything is correlated on this debt refi cycle, and they have to debase currency over time to do it, well, this may well be the best macro risk-taking opportunity of all time. And then when you just break it all down, what I did simply was divided all of the main assets by the global liquidity, or even the Fed balance sheet, whatever measure you want to use, M2 doesn't really matter. Nothing else goes up except the NASDAQ and crypto. And the NASDAQ since 2011 has done 17% a year returns, and Bitcoin's done 150. So you're like, holy shit. Okay, it kind of makes a mockery of anything else you invest in. Everything becomes suboptimal. So then people go, yeah, but what about the risk return, the volatility? That 150% return is after 3 80% drawdowns. They're included in that number. Oh, and the longer time horizon you take it, the more ridiculous it is. It's an alien asset class. We've never had anything like this. So I got to the realization too late that there is only one trade. And people hate it. People hate the fact that there's one trade and it's a new asset class. And they want it to return to the old days. They want to trade oil and they want to trade dollar yen and they want to trade, I'm like, all irrelevant. If our job as investors is to maximize our profits or protect our wealth, okay, wealth preservation may be marginally different, but if we're profit maximizers, then you owe it to yourself, because if not, every other trade is suboptimal, because there's no benefits of diversification. Zero.
Pal explains that traditional macro traders have struggled for about a decade. While there have been some successful trades like the buy bonds where diamonds trade, many macro investors have had difficulty finding profitable opportunities because they weren't focusing on the right factors. The continuous debasement of currency by central banks is seen as a form of insurance against the system blowing up. This debasement increases asset prices, which supports the financial system, but also diminishes the value of fiat currency over time. On the other hand, Pal acknowledges that many investors are resistant to focusing solely on cryptocurrency. They prefer to trade traditional assets like oil and currencies. However, he argues that this mindset is outdated and that investors should focus on maximizing profits, which he believes means investing in cryptocurrencies. Now, let's get back to what Raoul Pal has to say.
I noticed that Yellen went to China twice. Right, well, what's she doing in China? It's something to do with their debt refinancing cycle, because they need dollars, because their entire property sector is a dollar borrower. Right, so they've got a dollar shortage. There's a global dollar shortage going on. It started Silicon Valley Bank, all of that, rolls into Credit Suisse, blows out. Credit Suisse, big part of the Eurodollar market. Then the Japanese banks, they're the epicenter of the Eurodollar market. What's happening is they're starved of dollars. So dollar yen starts falling. And then Yellen goes to China twice. So Yellen needs to orchestrate this little dance. The dance is using Japan to scare the Chinese to do something. The Chinese don't want to devalue. Janet doesn't want to lend directly to the Chinese in swap lines. So she's going to backdoor it via the Japanese banks by getting the Japanese to intervene. That's how I think it plays out. The Chinese, on the other hand, will have agreed the other thing, because Janet is the world's largest junk bond saleswoman, and she needs them to buy bonds.
Yeah.
So she's like, I will get you the liquidity. We understand the Eurodollar market is in supply shortage. We will give you the liquidity via different routes. You will add to your treasuries. We can all go away. And then we've seen the trade deals trying to happen where they're trying to say, listen, the US can't run such a big deficit. You know, everyone has to kind of realign here or we won't get enough growth. Everybody needs that growth. A weaker dollar is the mechanism for the world to grow. Every business cycle, up cycle, is all about a weak dollar cycle. It sloshes money into emerging markets. China desperately needs it. The US needs to export goods and have people buying them. Chinese won't buy any goods because they're in a recession, essentially. You know, it's all of this dance at the bottom of the business cycle. Feels like it's going to get resolved. And the only way I think it gets properly resolved is the Fed need to cut, lower the interest differential, kind of shock the market, maybe July. I think you mentioned it on Twitter today. I have a tendency to think July or a strong signal it's coming, and then give the Japanese unlimited amounts to intervene. Mm-hmm. And we've seen that 2 or 3 times, almost every cycle. The Japanese have had to intervene in their currency markets, and then what you see is the dollar fall sharply. That ignites world growth. Everybody's, it's a much better situation. Yeah. The US have enjoyed the strong dollar in one respect, which is lowered inflation, but it lowers exports, which is why they're running a large deficit. So I think everybody knows the game that needs to be played. And that's why Yellen was in China for no other reason. GDP growth is driven by a magic formula. It's really simple, and every economist forgets it just in the mid-curving of being an economist. It's like GDP growth is driven by population growth plus productivity growth plus debt growth. Debt growth is robbing from the future. We blew that up in 2008. All debt growth now is just servicing of old debts. So population growth, productivity growth. Population growth, well, you can extrapolate that into the future. There is no population growth in the Western world. It is just shrinking and shrinking and shrinking. We've got a demographic time bomb that we know. Okay, so how do we get GDP when it gets worse and worse and worse every year? Productivity's been terrible too. Why? Because old people aren't very productive. No shit. It's not difficult to figure this out. And then you peer into the future and say, okay, how do we stop this dynamic? Because if this continues, this whole thing continues in this weird world of debasement and cycles and all of that. And really, it's about technology. It's about the AI and the robots are infinite population. People don't get it yet, but like Amazon has gone from 250,000 robots in 3 years to 750,000 robots. Soon it'll be got past the workforce of Amazon itself in human terms. And these things are 3 to 10 times more productive. So we are replacing an aging human workforce with infinite AI and robots. So what that does is makes a mockery of that magic formula. What, we can have infinite population? Well, the other side of that is, okay, well, infinite robots and AI means an infinite use of electricity and compute. So compute, everybody's solving the electricity side. Well, that is productivity. And productivity, again, I love the mid-curve take of spin to it. It's like the Europeans have no clue what they're doing. They're throwing money at this stupid green energy narrative. They completely understand what they are doing is forcing down the cost of capital into innovation in lowering the cost of electricity. Because fossil fuels over the years, basically, electricity costs have been stable. We haven't really made much progress with that. But we've seen the Moore's law working in EV and solar and in wind and in geothermal and eventually in nuclear. We've got more than enough energy. It just takes time and investment in technology for storage and distribution and all of that. So the Europeans are pouring money in. People don't realize the Chinese have been doing even more. The Chinese, 40% of their entire car fleet is now electric. And so they're all forcing down the cost of energy. So think of the magic formula. You're about to increase population infinitely, and you're about to, over the next 10 years, drop the cost of electricity by 75%. That multiplier is bananas. You don't need anything else to solve this.
Pal argues that traditional debt growth is unsustainable and largely used to service existing debt. Cryptocurrencies, particularly Bitcoin, are often seen as a hedge against the devaluation of fiat currencies due to excessive debt. Cryptocurrencies offer an alternative financial system less reliant on debt. Additionally, he points out that Europe and China are investing heavily in green energy, which will lower energy costs and boost productivity. Similarly, global interest in cryptocurrencies is growing, with various countries exploring blockchain technology for different applications. This global effort can lead to broader acceptance and integration of cryptocurrencies into the mainstream economy. Now guys, if you're watching this video, you're interested in crypto. If you want to stay up to date on crypto and Bitcoin, subscribe to my daily 5-minute crypto newsletter. It gives the latest expert predictions, any breaking news, and top on-chain analysis, all in a nutshell. Click the first link in the description to join over 60,000 others and become a better crypto investor. Anyway guys, that's all for today's video. I hope it brought you some value. I'll see you all in the next one, and as always, all the best.